Joining us on the show is Harsh Dhanuka, Executive Director, to discuss more. Harsh, good afternoon and welcome to the show. My first question coming to you is, with this kind of a deal with Bayer, by how much will your top line and bottom line get a boost?
Yeah, hi, good afternoon, Varsha. The numbers for 25 we have not shared as yet. However, I can share for the year 2023, the revenue for these products for Bayer globally was to the tune of 200 crores.
Right. Mr. Harsh, so how much revenue from existing partnership, if any, you have in Q2, and are there such more partnership in pipeline?
So these are the first time, this is the first time we have purchased external brands from a company. As per Dhanuka's business model, we've been registering a number of products from partner companies from Japan and Europe in India. And other than this, right now there's nothing on radar for adding any products through this mode.
Also, in Q2, we've seen a strong improvement when it comes to your EBITDA margin. Now, what were the drivers for the same, and what was the mix between the specialty and generic portfolio, and will you be able to sustain that margin, or you're seeing more improvement in the margins going forward?
During the last quarterly call, we have updated that this year we are expecting EBITDA margin improvement of 100 basis points. And with respect to the reason for the improvement in the margins in Q2 was majorly product mix. Some of our new products, which we have launched this year, Lenovo, Myco Super, and Perch, they have performed really well.
Right. So, Harsh, coming back to the Agri-Bayer deal that, the Dhanuka-Bayer deal that we've been discussing right now, first you mentioned Bayer had a revenue of around 200 crores from these products, right? Now, second aspect to it is that you will be taking over manufacturing as well as sales. So, how is it that the manufacturing is only going to be at the Dahej manufacturing unit, or you will be looking at some other aspect as well?
So these products are sold in combination with other technicals. So out of the two active ingredients that we have purchased, Iprovalicarb and Triadimenol, one of the products will be moving the manufacturing to Dahej over a period of time. It requires regulatory approvals in India, so it will take 2 to 3 years for the product to start manufacturing in India. Uh, with respect to the arrangement with Bayer, they will continue to supply the products for the time being, and the other co-formulants which are part of this product, they will be acquired from various companies who are manufacturing them.
So the ones that you'll be acquiring from Bayer, what's the
Mhm.
kind of royalty that you will be giving them till you start manufacturing them for the next 2 to 3 years?
So that will be just a supply agreement where they will be charging service fee for the production on top of the costs.
How much would that account for?
That number I cannot share at this stage.
Okay. And in terms of uh, after 2 to 3 years, once you start manufacturing these products as well, how much will it boost your margins? To what extent?
That definitely, because one of these products currently is being manufactured in Europe, and in India, we believe our manufacturing costs will be much lower. And with the optimized production processes and leveraging our existing infrastructure at Dahej, we believe that we can definitely improve the cost. The numbers will share in the due course.
Also, Harsh, so these products from Bayer, that comes under specialty one or the generic portfolio?
So for Bayer, definitely it's part of the generic portfolio because they are not covered under patent any longer, and they contribute less than 1% to their global revenue. So it is not part of their strategic portfolio. However, for Dhanuka, it will form a important part of our product portfolio, and we'll be focusing on renewing marketing efforts to revive the volumes which have been on a declining trend.
Got it. Also, I wanted to understand about your recent launches and the products that you have in pipeline for, say, next 2 years.
Yeah, so recently in the current FY, we have launched three new 9(3) products, which is Purge and Lenovo. as well as a biological growth stimulator, which is Mycor Super. These three products have received great response from the market, and we have been achieving our revenue objective for all the three products in this year. Going forward, we have a few more products in pipeline, including grape fungicide, paddy fungicide, and a paddy herbicide, which will be launched in next 12 months.
Okay, and so with these launches, what are you expecting your volume growth to be? Because in Q1 you had a volume growth of around 38%. In Q2, if I exclude your sales return, the volume growth is about 20 odd percent. So in H2 FY25, how are you seeing this volume growth?
So for the financial year on an aggregate, we are looking at a 16 to 18% value growth, and which will be close to 18 to 20% of volume growth.
Okay, and also margins. So for FY25, what kind of margins are you targeting? Will you see an uptick in margin?
As I mentioned earlier, the EBITDA margins, earlier we had forecasted a reduction in the EBITDA margins, but in last call, we have upgraded our forecast to 100 basis point improvement in the EBITDA margins in this year.
Right, because that's interesting to watch, Harsh, because clearly your top line has been revised from 18% to 16%, but your margins have been revised upwards by almost 200 basis points. So that's going to be interesting to watch out for.